Welcome back, Wealth Builders. Are you thinking about starting your own business? Well, that is super exciting and one of the fastest ways to build wealth. But one of the things I want to make sure of is that you know what you can and cannot deduct as a startup business owner. IRS Code Section 195 literally explains what you can deduct when you're starting up a business and what you have to capitalize. In this video, I am going to break it all down for you so you do not end up in a tax slinky. But before we jump in, I am going to ask you to comment all throughout the video so that I can answer your questions. What are startup expenses? Startup expenses are all the costs that you rack up before you start your business. For example, it could be legal fees, it could be research fees, it could be fees for creating an entity. All of those fees are actually what we call startup costs. And IRS came up with a code section that decides exactly how you can deduct those costs. All of those costs cannot be deducted in the year that you start that business just because you incurred that expense. That's why it's so important to understand what is startup cost and what is not startup cost. Code Section 195 explains exactly what startup costs are. So startup costs, again, are any costs that you incur prior to being able to conduct business. And the way that I like to explain it, let's say you have a Dollar Tree, you have a 99-cent store. If your store is not open to do business, any costs you incur prior to the doors opening are startup costs. Any costs after the doors open when you can start to do business are normal expenses. When you have startup costs, that cost may have started prior to the current year. IRS says that you can deduct $5,000 in startup costs in the current year, and the remainder up to $50,000 has to be amortized over 60 months. That means that any cost incurred above $5,000, it's not going to be written off in the current year. It's going to be written off in the next 5 years. So make sure you understand this concept. What is IRS Code Section 195? IRS Code Section 195 is the law that states what startup expenses are and the time frame for when you can write off your startup expenses. The first $5,000 in startup expenses that you incur can be written off in the current tax year. You can write off up to $50,000 in startup expenses, but that amount has to be written off over 15 years of time. You cannot take the remainder in the current tax year. And it's really important that you understand that so that you don't get yourself in a tax slinky. I want you to understand that in the event that you open up a business, and let's say you open up a 99-cent store or Dollar Tree, and if you're open to do business, that is not startup costs. If you're not open to do business and no one can come in your store and shop, any costs you incur prior to opening the doors are considered startup costs. The only costs that are not startup costs is the inventory that you buy to put on your shelves. Examples of deductible startup costs include legal fees of you starting your business. It includes research fees of you going out and researching in the market. It includes fees for getting all of your stationery and things that you need to operate your business before your doors are open. You cannot take deductions for those things. If you prepay rent, the amount of rent that is for the first month or the third and the second month of that year, you can expense those rents. But let's say if you paid a year in advance, you cannot expense that extra rent because that was before your business opened its doors. So you're gonna have to capitalize that rent and write it off over time. Employee recruiting, employee training prior to starting your business is also startup costs. So again, allow that line to be the date you can start serving customers and the date prior to serving customers. The date you received your occupancy license where people can start coming into your store. If you don't have a bank account open, you probably can't start serving customers. If you don't have a merchant account set up, you probably can't start serving customers. So make sure you are able to explain to IRS when you could start serving your customers. The benefits of IRS Section 195, it allows you to go back and grab costs from prior years. What if you were thinking about starting your business 2 or 3 years ago and you bought furniture for your business? You actually got a desk and you got some equipment, but you never actually started the business. But now that you are starting the business, you want to be able to grab all of that cost and classify it as startup costs. Therefore, no costs are left on the table. It takes us sometimes a long time to start a business, depending on the type of business that we are starting up. So it allows you to go back and grab expenses that you did not write off in prior years. When you're trying to deduct your startup costs, you want to be very careful. If your startup cost exceeds $55,000, you cannot write off any cost in the current year, not even the $5,000. All $55,000 has to be amortized over the 15 years. So you want to make sure that you are able to capture all of your costs and get your costs written off properly. The way you do that is connect with a tax professional that understands how to track startup costs. We're going to want to create a spreadsheet of all your expenses and how they were related to your business over the last few years. And then come tax time, we're going to classify that $5,000 as startup costs, and the remainder will be amortized over the next 15 years of filing your income tax returns. The only time you get to opt out of the 15 years if you were to dispose of your business. All of your startup costs that are remaining get to be written off in the current year. Here's the deal, my friends. You got to make sure that when you are starting a business that you understand all the requirements of starting a business. IRS places a higher burden on business owners, and ignorance is not an excuse. So make certain that you understand exactly what you can write off and all the different nuances of earning a business. And now that you know better, you know you have to do better. I am going to ask you to leave me comments so I can answer your questions, and make sure you track all of your startup costs.